Welcome to The Income Generation, the show where we provide information for the critical period in people's lives, when they're either in or approaching retirement. Each week I help you discover useful actions that serve to make this journey much easier. I'm David Scranton, your host. I enjoy this opportunity each Sunday to share with you insight and expertise that I use in my own investment management practice. These are insights that you can either use as food for thought or decide to act upon while building or managing your finances, as well as the money that you need for retirement. Financing. It's a word that's used a lot, but when it comes to you, the income generation, what does it mean? Well, it's a simple definition, really. Financing is simply funding. It is, as I say, how are you going to pay for something? At times, though, it can be a bit tricky because if you're lucky, you have various methods, various choices available to finance something. To paint a clearer picture of what we mean by that, let's say you're looking to get another vehicle. One option, of course, is you can pay cash. More common, however, is that you borrow money from the dealer or from the bank, or you could lease it. Another option is that you can get a home equity line of credit, or you could borrow from yourself, such as borrowing from a 401k or through a life insurance policy. The point is that there are options, and when choosing between these options, it's not always clear from a mathematical or financial standpoint which one is best. There are different things to take into account, such as the interest rate that you'd be charged versus the amount of interest you would earn by investing. If you're borrowing from a 401k or life insurance policy, you have to consider this thing called lost opportunity cost. In other words, what are you giving up by borrowing from yourself? But despite how the math turns out, I always ask clients to do a gut check. The question isn't always about the numbers, it's also about comfort and peace of mind and what makes sense for you as an individual. Now, this is often counter to what members of the income generation intuitively try to do. We grew up on borrowing. The income generation was encouraged to use other people's money whenever possible. This may not be what's best right now. Now, there are certain positives to being debt-free that I want you to consider. And some of these positives may be more emotional than financially based. Some are intended to reduce your stress. In fact, stressing about money is the last thing that you want in your retirement years. Having payments and being charged interest is one way to add to your stress. I should even add that financial stress is a major reason for divorce and health problems. Living debt-free is one way to control your monthly outflows and be more certain to live within your means. After all, you don't know how much healthcare costs are going to rise in the future during your retirement years. Also, unexpected emergencies can happen, whether they're medical, or whether the children need financial help or grandchildren, or even providing care for an aging parent. After all, we are the sandwich generation. You just don't know. So keeping monthly expenses low can help reduce the stress when one of these things does occur. Joining us today is Larry Winget. You probably know Larry from his long-running TV show called The Big Spender. And later on, Marty Johnson and I will have a frank conversation about leverage and some of the surprise places where you're most at risk, places that you may not even know about. You'll also discover in today's show that as much as different generations have varying feelings about debt and about leverage, and those feelings may drift as they enter and then exit their prime earning years, different cultures can also have starkly different feelings about debt from their U.S. counterparts. A client of mine who was born and raised in the Middle East is a great example that there are many different methods of financing. In fact, it was early on in my career when I first met him. We were assessing his financial makeup and his risk tolerance level, of course, as advisors always do, when it was discovered that he had no debt. Now, this wasn't a surprise because most Middle Eastern cultures don't believe in paying or receiving interest. And as a result, they're typically forced to save up and pay cash for things. However, as we spoke, he mentioned his, as he said, car payment. I stopped and asked, wait a minute, you told me you didn't have any debt. Well, Iraj then continued to explain that he had done the math, and back then, if you had a car loan, it would cost you, let's say, about 8% interest. Conversely, if you had money invested in the bank, you might receive 5% interest. So he continued to explain that most people believe simply that they're going to have some kind of car payment for the rest of his life. So he asked himself, well, gosh, if I'm going to have a car payment for the rest of my life, then why don't I pay myself in advance, as opposed to always paying in arrears for the car that, I'm currently driving or was driving. Buying the first car now would be a challenge because he'd be paying off the first car in arrears while saving for that second car. But after that, he'd have only one car payment for the rest of his life. When he crunched the numbers, when he paid himself in advance while earning 5% interest, as opposed to paying for the car in arrears and paying 8% interest, he found that the car actually cost him 40% less. In other words, rather than having a $400 per month car payment, his so-called car payment in advance was now only $250 per month. So he simply set up a separate bank account where he made these payments each month, and then ultimately when he had enough money, he purchased his car. Again, once he got past the first car, for the first 5 years, his payment was 40% cheaper. Now, yes, we're in a different interest rate scenario now, but the concept is still very much the same and makes sense to a lot of people who actually plan this way. Now, here's a different question for all of you. Perhaps some of you have had to answer this question in your own personal lives. If you were about to retire and your employer had a traditional pension plan, the kind where you can get a guaranteed income stream for life, and that guaranteed income stream worth $37,000 a year, guaranteed for life. Or you had an option to take a lump sum of $500,000, but then you'd have to create your own income stream. The question becomes, what would you do? Well, in large part, it depends upon whether or not your main goal was to build your net worth regardless of how much income you might need as a retiree. In that case, then, you're what I refer to as being performance-based. Some people think, who are performance-based, they think of investing as a contact sport, where it doesn't matter how much money you need, you just want to get the maximum return you possibly can, mostly for bragging rights. Again, that's performance-based. I find every day in my practice, though, that most people are typically purpose-based. In other words, they want to earn enough to know that they can fulfill their goals, that they can have the income they need or want in retirement, and the confidence to know that they're simply not going to run out of money in this case. My client, in this example, actually took the $37,000 per year. Why? Because he was purpose-based. This is despite the fact that we are the firm that specializes in generating income in people's portfolios. Of course, another specialty of mine is being honest if I know that there's no way that I could generate the same or more guaranteed income for life off a $500,000 balance. And in this example, there was no way I could confidently get him that $37,000 a year. So that's why he took that income option. Now, this client is lucky that he came to me because other advisors would simply drool over the prospect of investing an additional $500,000 for a client. They may have found a reason to convince him that a lump sum invested would better fit his purpose. But my client knew that his purpose was generating income during retirement. The income stream that he had would last a lifetime no matter how long he lived. Now, yes, he loved his kids. He raised them, he put them through school, so therefore he just didn't feel compelled to leave them anything additional necessarily. His financial security at this point was more important to him. So in today's shows, I want to make sure that the old adages about always using other people's money and leverage are put into perspective based upon the times in which we live and the stage of life in which you currently exist. We have a great show planned today. Best-selling author and former host of the show Big Spender, Larry Winget, will be here to talk with us about different ways that people can find higher levels of financial success. Larry's often referred to as the pit bull of personal development, and I'm sure you'll see why in a few minutes, and has recently published a book called Grow a Pair. The book, of course, is about doing whatever it takes to get where you need to be in life. Now, it's time for our market breakdown.
closing numbers on the markets today. At one point, the market fell as if down a well, over 700 points.
Apple shares were just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Finally, there is an alternative. Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Even if you don't consider yourself a financial expert, chances are that you know the meaning of the term leverage as it relates to investing. What you may not realize, however, is that your money could be in leverage investments right now without you even realizing it. Now, that's important to know because in the investment world, leverage magnifies both gains when things go well and losses when things go poorly. On today's Market Breakdown, I'm going to talk about leverage and how to know whether your money might be exposed to a leveraging risk that you may not even be aware of. Now, this could be true even if you consider yourself to be a conservative investor and you believe that your portfolio is currently in line with your conservative values. See, the simple definition of leverage is as follows: using borrowed capital to increase the potential return of an investment. The example you're probably most familiar with is buying stocks on margin. And if you're anywhere near retirement, you probably already know how risky that can be, and you would never dream of doing it. Now, that's a good start. But what you may not realize is that in most cases, buying any kind of stock itself, or stock mutual fund for that matter, represents a leveraged strategy. That's simply because most businesses have debt. If a company in which you're invested is worth $10 billion, but has $5 billion of debt, then it's 50% leveraged. And while a business can use its leverage to try to generate shareholder wealth, if it fails, then the interest expense and the credit risk of the default actually destroys shareholder value. Again, the leverage accentuates both gains and losses. It works in your favor when things are going well, but also works against you when things are going poorly. So while buying stocks on margin is even worse, that's only because it adds leverage to the leverage that already exists in most stocks. Obviously, leverage investments are one more example of how debt and borrowing can work against you. I'll talk more about other examples and alternatives for avoiding them a little later in the show. But right now, I want to focus on how leverage can be jeopardizing your portfolio even if you're not heavily invested in stocks. You ready? Let's say you consider yourself to be a conservative investor. Wait a minute, how could this possibly happen if you're a conservative investor and you're not leveraged by buying stocks? Well, it might start with having a broker or a financial advisor whose definition of conservative investments is both outdated and misleading. What he considers to be conservative may really just be the conservative end of his own aggressive business model and the options therein. He may not even offer any truly conservative strategies, and this might be because he lacks the expertise to manage them, or it could be because he's married to an outdated 1990s stock market-based business model. And he's been married to it for so long, and he's simply unwilling to change, in which case, for him, fixed income strategies might just be an afterthought. For example, this is why a lot of brokers use bond mutual funds as a default for their more conservatively minded clients who want bonds. Bond funds offer a relatively simple way to diversify in the bond market. And although they're considered safer than stocks in many ways, bond funds still fluctuate in value. They might be considered conservative in relation to stock funds and common stocks, but definitely not in relation to other income-based alternatives. Why? Well, income-based investments are my strategy. I try to teach people how a diversified portfolio of individual bonds is safer in many ways than bond mutual funds, even though it may not be as easy for your advisor to implement. As I pointed out before, default risk aside, individual bonds come with two important guarantees that you simply don't have in a bond mutual fund. First, a fixed interest rate. And second, a guaranteed return of principal when the bond matures. Overall, I believe that individual bonds and bond-like instruments are the more conservative option for many people when it comes to investing for income. But your broker may not see it that way. Again, it may be because he lacks the training and expertise to deal in individual bonds, or simply because he's married to a certain business model and resistant to change. And if that's the case, then I'd encourage you to find out whether any of the bond funds that your money's invested in currently are closed-end bond funds. If they are, then you may be at even a greater risk for damaging losses than you realize. And this is for two reasons. Number one, most closed-end bond funds use leverage. Not all, but most. If they raise $1 per share on their initial public offering, then they may go out and borrow 50 cents. Therefore, they buy $1.50 worth of bonds. And again, leverage works with you when things are going well and against you when things are going poorly. With the Federal Reserve having started raising interest rates, not only might the underlying bonds drop in value in the closed-end fund, but the bond fund's cost of carrying the debt, that is their interest expense, could also go up. That means that you can get squeezed because not only the underlying bonds drop, but the company's borrowing costs increase. Number two, and perhaps even more importantly, is that even without the risks of leveraging, closed-end bond funds are still the riskiest option for buying bonds, in my opinion. They aren't like a regular open-ended mutual fund you might be in with Fidelity or Vanguard, for example. See, in that kind of open-ended mutual fund, the mutual fund family creates an expanding and contracting number of outstanding shares based upon demand. If you buy shares of a mutual fund from them, you literally buy it directly from the mutual fund family. If you want to sell those shares, the mutual fund family actually buys it back from you. A closed-end bond fund doesn't work that way. A closed-end bond fund is actually traded like a stock, which means it's issued with a finite number of shares. This means that if you want to buy it, someone has to sell it to you, just like any stock. And if you want to sell it, someone has to be in the market to buy it from you. Why? Because it has a finite number of shares. And because it has a finite number of shares, the price can change more dramatically based upon supply and demand forces. This makes closed-end bond funds extremely volatile. How volatile relative to other options? Well, let's say for a moment that the face value of a bond or that of the underlying bonds in a bond fund is $10. Now let's say that the market value drops to $9. If you own individual bonds, I would argue that your bond is still worth $10. Why? Because you have the option to hold that individual bond to maturity and get the full face value back. If you have a regular open-ended bond mutual fund, then your bond is worth what the market says it's worth, $9. Why? Because you don't have the option of holding a bond fund to maturity. But if you had a closed-end bond fund, it might only be worth $8, either because of leveraging or because of the magnified effects of decreasing demand that together can have a significant effect on your losses. Essentially, when you're buying a closed-end bond fund, you're actually just buying the stock of a company that owns bonds. And I'll say that one more time. You're not buying bonds, you're actually buying the stock of a company that owns bonds. You end up having 3 degrees of separation from your money. And if you're in such an instrument, it may be precisely because your broker or advisor is tied to an outdated and aggressive stock market-based business model. For whatever reason, he may be so married to this model that even when you want to buy bonds, he may favor the stock of a company that owns bonds over buying individual bonds. What's even more disturbing is that he may actually consider this to be a conservative option. So if you believe true conservative financial strategies that reduce risk are important to you, which they should be if you're close to retirement, then make sure your broker's definition of the word conservative is in sync with yours. Make sure he's not just talking about the conservative end of an aggressive stock market-based business model that has been out of whack with market conditions and reality for 16 years now. The reality is this: the high-flying buy and hold 1990s are long gone. The long-term bull market that ran through the 80s and the 90s ended in the year 2000. So it's important to be sure that your advisor or broker isn't still stuck in the 1990s mentally when it comes to your hard-earned dollars. If he is, then you could be exposed to certain leveraging risks in your portfolio without even realizing it. I'd suggest finding out, because the fact is there are a lot of other options. By that I mean lower risk, income-based alternatives that are far better suited to the market conditions and realities of today. Far better suited, in other words, to the income generation. We're going to take a quick commercial break now. When we get back, I'll be joined by Larry Winget, and we'll be talking about lifestyles and how to improve on what we already have. Stay tuned. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Joining me now is Larry Winget. Larry's a best-selling author, television personality, and social commentator. His latest book, Grow a Pair: How to Stop Being a Victim and Take Back Your Life, Your Business, Your Sanity, is a New York Times and Wall Street Journal bestseller. Larry, so why did you decide to write a book and specifically to name it Grow a Pair?
Well, Grow a Pair is a statement most people are familiar with, and they know exactly what it means. I wrote this book, as I do all of my books, this is my 6th bestseller, in response to a problem I see going on in society. And the problem I see is that we become a society of wimps and weenies who don't know their core values, don't stand up for themselves, don't have much of a backbone. We've become so politically correct that we're afraid if we say anything it might offend someone, and we get offended way too easily. So I wrote a book that takes that on in every area of life and business.
So tell us how Growing a Pair then directly relates to personal finance. Let's start there. I know you talk about that a lot in the book.
Well, the best way to feel like you're in control and to feel powerful, and this is a book that helps you feel more powerful in your own life and how you run your life. The best way to do that would be to get in control of your finances. I think it makes sense to work from a budget. Even if you're in the hole, once you know where you stand, in every area of life, but certainly with your money. When you know where you stand, that is a position of power. Even if you're in the negative, you know where you are and you know what you need to do, and you can create a plan to fix it. So personal power comes from knowing where you are, who you are, what you believe in, what you stand for, having a plan to get better or to fix any problem you have. All of those things, personal power, especially with your money.
So it's running a household like a business. I mean, the reality is, even if businesses are heavily positive cash flow, they always have to have a budget. They're expected to. In fact, you talk about how to grow a pair in your own business a little bit in the book. Talk to us for a moment about that.
Well, when you look at most businesses, it's a shame that we've gotten to the point that we have the inmates running the asylum. We have too many business owners and too many companies who are running scared from their employees, who wouldn't dare go to an employee and say, look, I expect you to be here on time. Really, because what if that employee sued them? I say it's better to fight people on the outside than from the inside. And the problem is, once you start to tolerate bad behavior from your employees or even from your customers. We spend way too much time putting up with bad customers who don't pay us and so forth. But when you tolerate, you are in essence endorsing it. And why would you ever endorse bad behavior? We need to clearly communicate to the people who work for us as company owners and bosses. We need to communicate our expectation and impose consequences. In other words, we expect people to work when they come to work, get there on time, do what they're paid to do, give us all of their time. When you've got 25% of American workers who work in an office job on spending their time on personal business, 2 hours of their day, 25% of their time on personal business, that's called stealing. We've got to stop putting up with stuff like that. And it comes back to, you need to grow a pair and shoot your employees straight.
It's like the personal finance game. You know, if you get off on the wrong foot and you get used to spending more than you make, it becomes a habit. And the same is true here. If you allow people to get away with things early on when they first come aboard, then it's hard to change it. If you try to change it, it's always easier to start off on the right foot than it is to try to change it after the fact. Do you agree?
Oh, absolutely. And see, that is one of the problems we have right now. We have people who are so tolerant and used to putting up with bad behavior and bad service and so forth, and now they suddenly want to make a change. And I give people some ways they can make a change in here about learning to speak up for yourself and speak up for what's right. And that's hard to work backwards. Take that into parenting. I wrote a best-selling parenting book, and I have a lot of people say, look, my 16-year-old is out of control. Well, listen, your 16-month-old wasn't in control. And now you're expecting to go in and at the age of 16 and suddenly have a great kid who listens to you and behaves and minds you when you tell them to do something. You've got a hard road ahead, because now you're working in arrears. You need to start early, start young, whether it's with kids or with your employees.
That's great advice, Larry. That absolutely is. In the last minute we have here, you know, are there any other secrets for people who just aren't as proactive? I know you and I own businesses, so we're very proactive individuals. We're very honest with ourselves. Not everyone's like that. Any other secrets you can share with viewers who might be just a little shyer than us?
Well, first of all, there are no secrets. I don't believe in secrets. I think everybody knows what it takes to be successful. The problem is never that they don't know, it's that they don't do what they know. Here's what I tell folks to do. Get you 3 sheets of paper. Write down where you are in your life, your business, your finances, your relationships. Make a list of how your life looks right now. On the second sheet, tell me how you'd like for your life to look. And so now you have parallels. This is how it is. This is how I'd like for it to be. On the third sheet, figure out what you're going to give up to get from where you are to where you want to be. Success is about sacrifice. You can't have it all. You're going to have to give something up. You don't get rich. You give up what's making you broke. You don't get skinny. You give up what's making you fat. That's how it always works. So what are you going to be willing to give up? If people will do those 3 sheets of paper, their life will turn around.
So we have the 3 sheets of paper. We have figuring out what's really important to you in your life you're not going to sacrifice. But the first step for our viewers, the first step is go out and buy Larry's book, Grow a Pair, How to Stop Being a Victim and Take Back Your Life, Your Business, and Your Sanity. I think that's a great first step. Larry, thank you so much for being with us today.
Thanks for having me. I appreciate it.
Great. And for our viewers, stay right with us. We'll be right back talking about debt in just a minute right after the commercial break.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Thanks, David. As you've talked about, debt and leveraging can lead to trouble in so many different ways, and a lot of Americans learned a very hard lesson about that during the mortgage crisis. We're seeing a lot of countries around the world now with these huge sovereign debt problems that are affecting global financial markets, David.
Including our great United States of America right here.
That's right. And right now, as you've talked about on an earlier show, so many of these people are having this problem. It's a very timely topic. But I'm curious, have you yourself ever had this problem with a credit card getting out of hand?
Well, of course I have. Fortunately for me, it happened early enough in life where I was able to learn some valuable lessons from it. I was in college and I was trying to be the big man on campus. And everyone else could afford to go to spring break, and I was working full-time going to school. I really couldn't afford to go, but I wanted to go. So I had, at that point, one credit card. It was a Shell gasoline credit card. So I decided, I had this great idea, this ingenious idea that if I just drove to Florida with my credit card, I could fill up my tank free on the credit card. And then if I did that, then every time the person next to me was filling up, I can also put their gas on my credit card, have them give me cash, and in essence, when I get to Florida, I could have money. So
this sounds like a Shell game with a Shell card.
No pun intended, exactly. So we get to Florida, and I actually have over $200 in my pocket, and I paid for all the fuel. So now it was a great vacation. We spent 3-4 days. I spent all kinds of money and so on, worked my way back up north. But of course, you can imagine, by the time I got home, shortly thereafter, the bill was waiting in the mail. And that was the time for a rude awakening for yours truly.
Now, let me just point this out. In those days, credit card bills weren't like they are now. My credit card bill, when it arrives, it has a little notice that says, if you pay off the minimum amount, you will be X number of years into your retirement before you get it paid off. It wasn't like that at all in those days.
No, the disclosure wasn't that great, but I could tell by looking at the amount of the minimum payment that I was going to be here for quite some time working on it. It seemed obvious. And
that gets to be like a treadmill.
It's a lot like a treadmill, exactly. And people don't realize when they charge, they don't realize that they're really paying that one expense off years and years in the future. In this case, by the time I got that credit card actually paid off, even the memories had been erased from my mind. I had forgotten half the fun times we had. Thank goodness I had photos to remind me.
Did you learn your lesson?
I learned my lesson, absolutely, in that regard, yes.
So what exactly happened with all this? What was the outcome?
Well, the outcome was I was working full-time, putting myself through school, so I had to just work a little harder. I had to get it paid off, and I did. Eventually, I got it paid off. But that's the credit card lesson. You know, then there's other lessons that you get subsequently in various areas when it comes to debt, because credit cards aren't the only debt.
Now, is that going to be where we learn about the book Return on Principle? Ring a bell?
There are some lessons in the book, yes. There are some lessons about some other things I'd done, whether it's taking a car loan, an unsecured loan to buy a car, and deciding that I didn't need collision insurance because it wasn't an official car loan. And the car got totaled, and then, of course, I ended up having to get another car and take an actual car loan. So now I'm paying off 2 cars at once. Or to a business deal gone poorly back in my 20s.
Now let's talk about that, an unsecured business loan. Tell me about that experience.
Well, I call it a business loan in the book, but it's really not a business loan. It was basically back in the day where you can walk into a bank or credit union, and if you had good credit, you can get, $10,000.
And you had good credit after paying off that credit card bill.
I had good credit because I did pay it off.
Sure.
Correct. And they figured I must have been making a lot of money if I were able to afford those payments. So I went to different banks to borrow money. And I'd gone into business with a fellow that was a high school friend of mine whom I trusted, who was a builder. He gave all the outward appearances of being very successful financially. And of course I knew him, so I trusted him, which was mistake number 1. So I borrowed all this unsecured money to go ahead and to invest in the business. Well, it wasn't too much later in terms of time when all of a sudden the business was doing poorly. This fellow had all the outward trappings of success that drove around a Ferrari and so on, all of a sudden was selling the Ferrari and saying we're having business problems. So, and this is in our 20s, by the way. So, of course,
ouch.
with these business problems, I then started to get a little suspicious. And there's one excuse after another. So finally, he said, you know, there's a guy, and I'm just going to use the name John Smith, for example, although his name wasn't John. So there's a guy named John Smith who lives in California who owes us money. If we can get this guy to pay us, we'll be in good shape. Now, this is before the internet. So I decided I was going to get on a plane and go to California. And I went to every major city in California, and I went to the library and looked up John Smith on microfiche. And there were a ton of them. But I went on this mission that I was going to find the person. And lo and behold, I finally walked up to somebody's house one night at 8 o'clock. And I said,
Really?
I'm so-and-so's business partner. And he just put his head down and he said, come on in, I want to show you something. And he proceeded to show me a canceled check of proof that he had actually paid our company back. And it was really my partner that was pocketing the money, using it to pay for his lifestyle and lying to me.
Did you have any legal recourse at this point?
Now, well, I did have some legal recourse. So I actually had my attorney put a lien on his house. And this is where the story gets really interesting because about 2 months later, I get a phone call and I find out that ATF, Alcohol, Tobacco, and Firearms, was sitting in my office.
Federal agency.
Yeah, and what's going on? Well, come to find out, the night before, he had decided, since I had put a lien on his house, the best thing for him to do was to hire somebody to burn it down. But they didn't do a very good job, and they actually blew up the house instead, causing an explosion. And as a result, I have ATF sitting here, knowing about the business deal, wondering if I was the one who actually had burnt his house down. And of course I wasn't, and he ended up going to jail for almost 3 years, federal penitentiary.
Wow.
I never got my money back, and I was forced to pay that back myself just through hard work.
So in your 20s and huge lessons.
Talk about a huge lesson at that point, that's correct.
Where do you go from there?
Well, you know, I really want to help our viewers understand that leverage is dangerous on all levels, and I want to make an analogy, I think, that helps them understand the difference between a stock and a bond in their portfolios.
Now,
And
that's where I think a lot of people are confused.
Well, I made the comment earlier in the show that if you own a stock, you probably already have leverage in your portfolio and not even know it. And I said the reason is because most companies that have publicly traded stocks also have debt, right? Okay. So let's say that President Obama were to come out and pass a law. Now, I know that's really hard to imagine that this might happen, okay? But just work with me here for a minute. President Obama comes out and he passes a law.
Signs the law.
Yes, yeah, that says, well, you can only have a home in one person's name. You can't buy it in two names. Now, let's say hypothetically, for some crazy reason, you and I wanted to buy a house together.
That does sound crazy.
Right, exactly. So now we'd have a dilemma. So I come to you and I say, Marty, let's put the house in your name.
I like this.
And I will lend you.
This is a great story.
And I will lend you the money. That's right. It gets better. So it's not so great yet.
Okay.
But,
wait, who's this going to end up great for?
But it depends which way the housing values go, right?
Ooh.
So we decided to put the house in your name. I'm going to lend you half of the money, so you have the money to pay for the whole thing, but it's in your name. So let's say now we go out and we find a house that's $200,000. So I lend you $100,000. And let's say you pay me 5% interest. You with me?
Sure.
Okay.
Absolutely.
So now the house goes up in value a couple years later. It goes from 200 to 250.
My house just got better and better.
How much money did you make on your investment?
I made $50,000 minus what I owe you.
That's right. So your 100 went to, let's say, 150. Forget about the fact you paid down a little bit of principal. Okay? Made a 50% gain.
Okay.
How much did I make on my investment?
You made 6%.
I just made the interest.
Right.
5 or 6%. Same thing. Now, what if the opposite happens? What if instead of the real estate going up to 250,000, let's say it dropped to 150?
You find out what a whiner I am?
Then I find out what a winery you are. That's right, because now you've just lost half your principal, correct?
Right.
Okay. How much money have I made?
Dave, we're friends.
Come on, work with me here. How much money have I made?
I hate to say it, but the 6%.
We're friends until business is business, right? That's what
Yeah,
happens.
I think that's
right.
exactly what it is. It's on paper.
So in this example, I still made my 6%, and
You've left me holding the
half your money.
bag.
I'm still secured in my investment, but you lost half your investment. Now, what if the value drops below $100,000? What if the house now gets down to about $90,000 in value? Now, what's your investment worth at that point?
$90,000, maybe.
Well, what's your portion of it worth?
Minus the 50, 40,000?
It's worth this is proof.
This is where I get
This
tearful.
is proof that all television reporters do not know mathematics, okay?
We do flunk math classes, legendarily.
Well, the answer is it's zero, because you wiped out all of your equity in that home.
That's right,
The house
I
is worth
did.
$90,000, you still
I
owe me.
wiped out my equity plus I owe you, so I walk away from it like how many Americans did in the last 10
well,
years.
that's the point. You know, the question then becomes, how much is my investment worth if that house has dropped in value to $90,000? Well, some might say, Dave, your investment's worth $100,000 because Marty's your friend and she's going to pay it back no matter what. But you may return the comment that I just gave you.
I'm a good person.
You may say, business is business. I'm walking away, again, just like millions and millions of people did during the housing crisis 2008 through 2010. In which case, now my investment isn't worth $100,000 anymore. It's only worth $90,000 because I can only get back what that house is ultimately sold for.
So did either of us make out well on that one? I don't think we did.
Well, you made out better in one direction. I made out better in the other direction. I had to make it well-rounded because I didn't want you to get cranky at me. So at least in the first example, you had an opportunity
Be
to make
kicking
some
him in
money.
the green room after.
That's right. But this is a great analogy for how stocks and bonds work together in a corporation. In this analogy, obviously, I was the bondholder who was protected in my value, my investment, until the house got down so low in price that it was worth less than the actual bond. You were the equity holder, so you took all the residual risk, but you also got all the residual reward.
So you got your 6% back, and basically I was the gambler in this scenario.
You were the gambler. So you were the stockholder, and you, in essence, had leverage on your stock. Even though, why did you have leverage? Because your gains and losses were magnified because of the fact that I had the lien on the house. So hopefully that helps for our viewers get a really good feel for how stock and bond holders both coexist in a corporation and how that creates leverage for virtually every stockholder. Stay right with us. We'll be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Over the years, the United States has become an installment debt-based culture. We can now debt finance virtually everything from food to vacations. And many of these things don't have any economic payoff. They're worth virtually nothing by the time the bill comes every single month. Think about it. Today, major and minor purchases like cars and even furniture are quoted in terms of monthly payments. Often you have to dig to find the full price, and what's worse, the term of the loan is in excess of the useful life of what's purchased. Even Amazon and PayPal encourage you to make your purchase using their payment installment plan. And how many times have you been prompted to pay nothing now, we'll bill you later? This is often an attempt to turn it into an installment sale. Living with debt has become normal to the income generation. And since it's still the beginning of a new year and you're at a time in your life where there will be fewer second chances, I'm asking you to be smart and not necessarily normal. Long-term happiness can come from financial peace much easier than owning a bunch of stuff. If you haven't already made the choice to reduce stress by minimizing debt, I encourage you to make that choice now. The question becomes, where can you cut back? Start by talking to your spouse or partner. Many couples, when they were younger, were fantastic planners and savers. They had to be. They cut corners and clipped coupons because they saw that it put them in a more comfortable position. If they did it right, they had fun being financially savvy. Many of those couples, decades later, don't even give it much thought anymore. It's become a habit. But if that's not you, but you want to be more secure in the future. But you know you've fallen into a few wasteful habits, and I urge you to take yourself and your spouse out of automatic spending pilot. Cutting back on spending can buy peace of mind for you both. One day you'll be glad you did. So what types of liabilities might be able to be trimmed? Do you have a country club membership that perhaps you don't use all that often? Or a restaurant habit that isn't worthwhile or even healthy for that matter? Perhaps you have a boat depreciating at the dock, and worse, dockage fees offering no reward at all. There are many places I found that my clients have been able to save and cut corners. One popular area is part of your cable bill that isn't used. Another way of providing found money for clients is cleaning out storage units to downsize or completely eliminate the expense. This found money can be used to reduce any outstanding debt and pay it off quicker, or to increase retirement savings or rainy day fund. My clients tell me the calmness and peace of mind that comes from having lower monthly payments gives much more pleasure than the country club membership or 300 cable channels ever did. Unfortunately, surprises and emergencies do happen. It could be your son or daughter that has to move back in for a while, or needing to help your mom make her home wheelchair accessible, for example. Or it could be a freak storm that drops a tree on your roof. The fact is, these emergencies are much less stressful when you're prepared for them. Here's one surprise that I see all too often tear finances apart of people who are not prepared. It's when a member of a married couple needs skilled nursing help. Medicare actually covers 100% of the cost of a semi-private room, meals, and skilled nursing and rehabilitative services, as well as medical supplies. But here's the catch: only for 20 days. Beginning week 4 in a nursing home, there's a daily copay of $157. That's $1,100 per week and more than $4,700 per month. After 100 days have passed, you're responsible for all the costs. So having as big a rainy day fund as possible becomes very important after those first 20 days. In fact, you won't have a chance to build one later. In most states, the Medicaid rules allow a healthy spouse to retain some of what they're earning, but it's typically less than $20,000 a year. And they'll take anything you have in terms of assets over approximately $100,000. When I instigate this conversation with couples I work with at Sound Income Strategies, our company, I often find that deep down, the female has what's referred to as a bag lady syndrome. This isn't my word, this is actually their term. They have almost a secret worry about being left with nothing. Men at times have a different reaction. It's been their place to feel that they've been there to say yes to providing for things at all times that maybe none of them really needed or even wanted. Do yourself a favor. Make a date to have this casual conversation with your significant other. It's important that each of you knows how the other thinks and feels about money. Financing is all about how you're going to fund your costs. It's a new year now and a perfect time to weed out waste and put it toward investing in less stress down the road. Remember, a penny saved is a penny earned. I want to thank our guest, Larry Winget, for his insights on reclaiming control of our lives and making decisions that are in line with the right purpose. I also appreciate Marty's interview and asking me the tough questions about personal debt. If you haven't signed up for a complimentary special report titled The Income Generation, go to our website now. This is a great read where you'll discover many answers to your financial questions. Sign up now at theincomegeneration.com. Well, that's all for today's show. Let me leave you with this one more thought. It's 2016. Paying off your mortgage is in. Refinancing is very 2015. I'm David Scranton, and you've been watching The Income Generation, and we'll see you all again next week.